Wasn't long ago we heard about this Sell America trade, people apparently getting out of US assets, worried about unpredictability in the White House. We're joined now by Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Great to see you as ever. We'll talk about the interest rate cuts as well. But I wanted to start off, if I could. Bloomberg says that investors are happy holding US assets in general, but it's Hedge America. They're betting or they're buying insurance against losses because if the US dollar goes on dropping. Does that resonate with what you're hearing?
Yes, it does resonate, and we hear it in Canada. There was articles about pension plans doing big hedge ratios because they have a lot of US dollar exposure, so hedging it back to Canada. So what does that mean? It still means they like the US. They're just wanting to reduce the volatility of their holdings, and they're paying a price for that. Typically, when you're hedging the US dollars, you're lowering your overall yield. There's a cost to that. So it depends on where you are on the volatility, what your perspective is there, and what your outlook is for the US dollar as well.
It is interesting. I mean, I know, can you in any way generalize? Say I have a portfolio of $100 million in US Treasury bonds. What cost percentage-wise would it be to hedge that? And I know there's a million variables.
Well, no, it's actually very simple. What you do you look at the overnight rate in the US, which let's call it 4%, and you look at the overnight rate in Canada, so let's call it 2.5%.
Okay.
What's the difference? It's 150 basis points, 1.5%. Is the difference between, that's going to be your cost. So if you're buying a US asset where you expect a 10% return, you look at the difference in overnight rates, and you could estimate that your net return is going to be 8.5%, 10% minus that difference in overnight rates. Very simple way to get a sense of what that cost is.
So it is a penalty.
It is a penalty, yes.
Although I'm looking here at currency returns for Canadian investors. S&P 500 up almost 13% this year. But a Canadian investor owning the S&P is up only about 8% and change.
Yeah. And that just depends on, I simplified it, but it's your one-year outlook. It gives you a rough sense of what that is in regards to the costs for it.
Did anything surprise you with these interest rate cuts this week? Any of the commentary, for example?
Yeah, I actually did have a lot of surprise. My surprise in Canada was that it would be what I would call a dovish ease, which means they're more likely to ease again. And the reason why I think that in Canada, they said the risk to inflation is reduced. They're an inflation targeting bank. So if that's reduced, it makes it easier for them to ease next time. That's the only reason they would actually say no, despite what's going on, if inflation's too high than what we saw in 2022 and 2023. So that's one surprise, a dovish ease in Canada. The other surprise is it was a hawkish ease in the U.S. And, when the governor or Fed Chair Powell said this is risk management, they're not doing it because they foresee a recession. They're doing it to try to prevent one. So risk management, so what are the implications there going forward? It means the onus for now for eases in both countries is employment numbers. Inflation matters, but it's second tier. For 2025 at least. So we're looking, and that's why we believe, we're not going to see much in the markets over the next 2 weeks till we get the employment data for September. So we're not going to see much. We believe the markets are still good and buoyant. One thing I want to touch upon, your guest earlier, although very well spoken, we take a different view on the impact of employment on credit spreads. Okay. So the guest earlier said if unemployment worsens or gets worse, more job losses, he would expect credit spreads to widen. That's very possible. I'm not saying it's not. It's definitely a possibility. We would actually expect it to narrow. And the reason why we would expect it to narrow is exactly what I just said, the hyper focus on employment. So if employment gets worse, you know what's going to happen to central banks? They're going to ease more than what the market expects.
It makes corporate bonds more attractive.
More attractive, and especially, there's something people don't talk about quite often. In the US, there's $7 trillion in money market accounts. If they ease more than expected, that won't make money anymore. It'll make less money. That money is going to go into corporate bonds and risk assets. So we take the opposite side of the coin in regards. So we think higher unemployment actually is good for credit spreads right now. Lower unemployment and improving economy is bad. And the reason why it's bad In the US, they're anticipating another 100 basis points of cuts over the next year. If you get a pickup in employment and Chair Powell said, I'm looking at employment, they're not going to ease anymore. That will bring in volatility into the markets, and that's where we could see credit spreads widening.
That's interesting. Of course, we have a pretty small, obviously, corporate bond market in Canada. I don't think it's a big retail category. Some investors buy corporate bonds, but it's not that common.
Almost. There's two sectors in corporate bonds. There's investment grade. Right. That's BBB, and there's high yield. We have a very small high yield corporate bond market. Yeah, yeah. We have a very large investment grade. And actually, retail investors do invest a significant amount in, but through mutual funds, through what we do, what my team manages. The largest issuer of investment grade bonds in Canada is the banks. So that's where you do see it going into retail pockets through two forms. One is mutual funds, like what we invest in, and pension plans. Pension plans invest in a significant amount of Canadian corporate bonds because they don't have to hedge the currency risk, what we spoke about before, coming full circle around. Yeah. So there is a big market for investment grade, not a big market for high yield.
Maybe we could put up a 5-year chart for the Canadian 10-year bond yield.
Yeah.
And so if you say a blue chip bank, Royal Bank, and they issue 10-year debt, what kind of a premium typically would they have to offer over a Government of Canada?
Yeah, so we'll talk to investment grade if they're going to issue. It would be fairly tight, let's call it. And they don't do this. They don't issue 10-year government bonds. They issue hybrids and AT1s just for capital purposes. So this is a lot of speculation as to where that would be.
Yes.
But roughly an investment grade bond is 100 basis points over the government bonds. So
not bad.
Yeah. So, a bond that we like and we were looking at is a 5-year Brookfield. That's 100 basis points more than your 5-year Canadian government bond. So that's roughly where that spread is between, call it that 100 basis points plus or minus 10 or 15, depending on the quality of that investment grade. And that's what we look at.
Earl, thank you very much.
You're welcome.
Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management.